Welcome back to my YouTube channel, and apologies for not making my schedule on Monday due to my sickness. I'm extremely sorry for that. I am recording the video today, which is Thursday, and henceforth I'll repeat every week on Thursday. Market has a lot of buzz regarding impending recession in the US, and since we are investors, any recession happening in the US is going to impact India, and so is going to be our portfolio. Therefore, I thought let me dive deep into the causes and the factors which are indicating impending recession. Is it going to impact the market? Is the market going to fall by 20%, 25%? If so, what we should be doing and what precaution we should be taking? I'm going to proceed further and discuss about the topic of today. Coming back to the topic of today, CT is being forecast. A US recession is coming because of this indicator from the job market. Now, CT has analyzed something, and based on job market, this was published in Economic Times, and CT believed that the inflation is impending in the US. Now, the second thing, you look here, there's a news from JP Morgan. I have taken a screenshot of those news. The probability of recession now stands at about 35%. JP Morgan believes that although about 6 months back or about 1 year back, the probability was 50%, today it stands at 35%. So 35% is not a very low number which you can easily neglect. So even today, there is a chance of recession and good chance of recession which will be hitting the market, US market. And once the recession comes in US, India market will not remain untouched. Although we do have a very strong economy internally, consumption is booming. Even the last quarter, rural consumption has started picking up. But this all will depend on a conducive or supporting US environment. Because as you might be knowing that US, we do a lot of export of software and many more things. And US getting into recession will impact the whole world. And the third one, I want to show you, like Statistica, there's a probability curve they draw actually. And starting 20, it was about 40%, then it came as low as this one, then during 24, 23, 24, it has hit almost 70%. Now still it is about chance of recession as per Statistica is reasonably high, 35-40%. So friends, based on these three news, it appears that recession might be hitting America once again. Now if recession hits, what you should be doing? So I think we'll look at some more data, some more indicator, and we'll not go just through the news. And once we look at this data, these indicators, then I'll come back and then talk about portfolio. What one should be doing about the portfolio? Should he remain invested? Should he book profit? Should he sort of restructure his portfolio? All these items we'll discuss. What are the sectors which are recession prone and where there is a chance of high impact due to recession? So the probability of recession starting in the next 12 months has fallen but remains elevated. This is a Standard and Poor report. I have picked up some graph from Standard and Poor, which I like to show you. Now here, when you look at here, the the brown one, the shaded portion here shows recession. The last we had was in 2008, and we had a very short one, which was induced by the pandemic and 2019-20, but this was again, and due to government action, it recovered. So like when you look at this particular data, you see the percentage here. What happens is just before the recession, percentage is quite low. It hits quite low. So before the recession, the probability comes low, and as you know, anything which comes down has to go up. So and then there's a sort of all of a sudden, and the recession comes, it again trickles down, remains here, and the things continue. So from that perspective, we are here today. So the question is, although we are not at the bottom, so will it come down here and continue, or will it go? That is the point. So for answering that question, we have to look at some more data. Now here is a famous yield curve inversion data. What it means is, what is yield curve? So yield curve is basically, return on the government bonds. So when the short term and long term, these rates gets imbalanced. So basically what happens is, Standard of Poor tracks that. So the yield curve inversion means you have, if the sort of like 10-year treasury yield minus 3 months treasury yield. This means long term minus short term. If long term is high and short term is low, then it's okay. To the contrary, if long term is low and short term is high, that will give a negative, and this is the indication of inverted yield curve actually. Logically, long term should be higher and short term should be lower. But as you can see here, these are the points. Like during 1980s, there was a huge negativity here, and it followed with a sort of recession. Same thing happened during 90 due to short inversion. Here, dot com again there was a yield curve inversion. Then we had in 2008-9 the real estate bubble. Then we had a small inversion in the pre-COVID time, and again you had recession coming in. And now, friends, you see, it's a long time it is continuing. This means treasury yields for long term is lower than short term yield, and that is the indication of inversion. That is the indication of recession hitting in next 15-20 months or whatever. So, based on these two data, I think one can say that chance of recession is quite high. But before we conclude, there are leading indicator and lagging indicator. So what is lagging indicator? Lag indicator means two consecutive quarters. If GDP shrinks, this means growth becomes negative, then we say that recession has set in. I'll repeat, two consecutive quarters. If GDP of a nation shrinks, or GDP of the world shrinks, or GDP of a country shrinks, then officially we can say that recession has set in. Now, this will be known only when it happens. Therefore, it is called lag indicator. This means it is a post-mortem type of thing. And leading indicator means those indicators which gives you a pre-signal of recession coming in. So here, 9 indicators have been sort of listed by Standard Poor. And based on these 9 indicators, red means, yes, but this indicator, recession should come. Green means no. And yellow means, sort of neutral. So when you see here, if you count it here, like term spread, clearly indicating that recession is on the card very shortly. Credit spread, reverse. S&P 500, the stock market, has become positive in last May 24, April 24, it was negative, May 24 was positive. And so it's consumer sentiment. It's quite negative again. Here, when you look at building and property, negative. These two indicators, manufacturing data and bank indicator negative, and broad technical condition again neutral. So based on this, it is almost 50-50. So what exactly we should be doing? As we have already discussed that based on indication from JP Morgan and Citi, recession might set in. Chance of, we discussed that is about 35-40%, so it's not very high. So I think condition as it prevails today, Bank of America said that we are out of this particular difficulty and there won't be any recession coming in. So when you look at all these, I think we can call it with a some sort of confidence that still about good chance it might come. So therefore, we cannot be gung ho. And second important aspect is very much here, like stock market has run up quite a bit, and since it has run up, always anything which goes up has to come down. So from that perspective also, it appears that we might see a 20% sort of correction. Whether it happens in the early 25 or later, we don't know. Or it could be little delayed because due to the action of government nowadays, it really gets controlled. Earlier, in the previous curve, we have seen that recession used to happen very frequently. Now, due to the monetary policy, it gets delayed actually. Artificially, they are able to sort of like control it. So let's understand about what happens during the recession. So normally, when economy is booming, it picks up. Like at this point, we don't know what is the peak. This point, we don't know what is the peak. So peak is not only when it starts falling. So when it starts falls 2 quarters, we say that the recession has set in. Once this falls, it takes about almost 6-7 months to bottom in or touch the bottom of the trough. And here again recovery starts and then it goes. So let's say the first scenario, one remain invested. What will happen is there will be huge fluctuation here, maybe 20%, 25% in the portfolio. And if it doesn't do anything, it will go up. So that is one scenario. Second scenario is you adjust it. So the question comes, whatever adjustment you should be doing. which sector you should be getting into, and what type of things you should be sort of like investing in. So that I'll discuss. So the point is, and once it starts happening here, you know it is happening, and then you have some time to adjust your portfolio. So one need not be panic at this point in time. And since you cannot be panic, you should work very carefully. And I have a thesis. I said let's say 30-35% is the chance of recession. So whatever percentage of chance of recession is, maybe same percentage you can put in defensive stock and defensive assets. Like let's say in Indian condition, if you look at it, could be pharma, it could be FMCG, it could be gold, that type of thing. So all these investment put together today should be 30-35%. When that becomes 70%, you move those board here, and you should stay away from other this one. So basically, when you look at the curves here, see, earlier so many recessions were happening, but now they have been long time and there's no recession. So that also says anything which goes up, it fell down during COVID, and then it has a long run over here. Like the run it had 2008, similar run it had here. So maybe it can go up a little more, and then it will start falling. But one thing is certain, that one has to be very cautious at this point in time. And therefore, one need to work with the portfolio. So what you should be doing? So for doing this, cash is the king. So during the session, book some profit, particularly those stock which has run up a lot, which has sort of great profit you have, or which is very expensive, you should start booking profit. Secondly, own defensive stocks like FMCG, pharma, in Indian context, and maybe some of the cyclicals which are just the bottom at this point in time. Cyclicals are that requires further study. Third is use dollar cost averaging. Like if you are certain about certain stocks, which is very good, and you procured at a higher price, and you don't want to get rid of this stock, you know this is going to go up. Your conviction is there. So there you start averaging out little more so that your price comes down. Keep quality assets. So any asset in your portfolio which is not quality stocks, like let's say if I have to talk about Tata Consulting Services and a chota company, a very small company of IT, which a lot of hype is there, I'll prefer Tata Consulting Services. So because it's a quality company, quality stock, so it's not going to vanish. And during a recession, a small company might have a existence risk, but large company which has proved and which has really shown their performance, they are not going to vanish. Growth stocks, avoid growth stocks like small cap and mid cap. Those are typical growth stocks. So number one also I said you book profit and avoid that. Invest in dividend stocks. Well, but dividend stock again the trouble is it may remain, it may not remain. And or if you are so secky about this, you can put your investment in bond and gold. So these are some of the points which are really can help you during recession. So friends, in this short video today, I discussed about the chances of recession which is going to touch US and eventually impact India. If it happens, then what to do? So there's nothing to be panic about. There could be a 20% fall. Even though you sit idle, remain invested, you will have about a year and a half, and after that again you will go higher than what you are having value today. So particularly those who have got 10 years, 5 years perspective can relax. But who want to maneuver? Well, they can adjust the way I have talked about getting defensive stock, keeping cash, uh, like cyclicals, if it is at the bottom, growth stock you have avoid, and many more things which I discussed about. So, and if you do this, probably you can make a little more money. It is, but let me tell you one thing: it is extremely difficult to time the market. So therefore, these are more theoretical in nature. This gives you a general guideline, and if you remain engaged, it will generate interest also. Why I did this study? Because I have been also looking at this news. So I thought, in order to safeguard my investors' portfolio and also my own portfolio, I need to go a little deeper, and that's why whatever I understood, I have presented in front of you. I hope you like this discussion. If you like this, please do press the like button. If you have not subscribed to the channel, please do subscribe to the channel. Once again, thank you so much for your time. Remain engaged. Jai Hind, Jai Bharat.